Some major changes are happening over at the Fed, changes that will shape the financial landscape through the rest of the decade and that will likely impact markets, crypto, and of course, XRP. This industry sweeping announcement is basically the Fed's confession on the true strength of the US economy. So in this video, we'll be covering exactly what Jerome Powell and the Fed are up to and why that matters for markets and you. We'll be covering the bond market and what recently happened that's a major signal of an incoming bear market in the near future. We'll be running a quick overview on gold and what it's signaling for markets right now. So buckle in because this video is going to show you exactly how you can prepare for all situations into the end of the year, whether we see a final blow off top and a rally in crypto markets, or whether markets continue to remain dull and sell off for the weakest crypto bull market of all time. And by the end of this video, I'll give you my personal take and what I'll be doing with XRP and my portfolio moving forward. So if you're feeling blessed and bullish, comment 777. And if you're going to be the richest person in your family tree, smash the subscribe button. Before we dive in, a quick reminder that the opinions in this video are for informational and educational purposes only and do not constitute financial, legal, or investment advice. All investments, including cryptos, carry risks and potential losses. Always do your own research and consult with a licensed financial advisor. We are not licensed financial advisors, and relying on our content for financial decisions is at your own risk. By watching this video, you agree we are not responsible for any losses or damages, and we do not guarantee any specific results or outcomes. Some of the links below may be affiliate links, and we may earn a commission, which actually helps support this channel and helps us to create value-based videos like this. We also hold some positions in the cryptocurrencies that we talk about, but that's only because we do what we believe in. However, this should not be interpreted as a recommendation for you to do the same. With that said, let's get into the video. So here I have a chart of the NASDAQ on a weekly time frame, and the economy has been quite resilient from its lows back in January of 2023. Consistently, people thought we were going to enter a recessionary environment sooner, yet markets continued to rally because people in the US and consumers continued to spend money, even though inflation remained ridiculously high. As you can see here, the US aggregate inflation rate over the last 4 years has been about 25% per year. That means you've lost 25% of your dollar's buying power every single time you go out to spend some money. People continue spending though, and that's why the economy has seemed so resilient. Then off the tails of stuff like AI and strong earnings, people continue to flood into the markets, right? Pushing the markets further up. So people continue to think things are all fine and dandy, but at the end of the day, the consumer is getting squeezed. And that's evident on a few different charts. Right here, I have the personal saving as a percentage of disposable personal income or personal income. And what this means is people from, the local highs back in March of 2020 when they were getting all of their stimmy checks have actually run out of their savings. And now we're at local lows that we haven't seen since March of 2008. That is a very big deal. Then when you look at the delinquency rate on consumer loans across all commercial banks, this thing is trending and ticking up to highs that we haven't seen since the tail end of the Great Recession from 2008. So things are looking pretty interesting right now. People are going to run out of money to spend because ultimately they're no longer going to have access to credit cards to spend it. And so although the NASDAQ has been leading the market and tech stocks have been leading the market for quite some time, that looks like things might be ending soon. Considering when I pull up a weighted MA at a 34 period, you can see that consistently this has acted as a support throughout the range with, a few bear traps along the way. But it looks like we're finally breaking down considering this is now a lower high right here relative to the previous all-time high. And we got a really nasty breakdown below the 34 MA. And now we're kind of playing with this line. So if we break below the these lows right here between 17,000 to 17,000, then things are going to start to look ugly for markets, especially when you consider the fact that laggards, stuff like the S&P 500, are falling behind as well and putting in lower highs or double tops too. So a breakdown below this 34 MA on any serious time frame like the weekly would be a very big deal, and that would signal that markets are in for a bit of a downturn. Because when you look at previous downturns like in 2022, right, we would play with the line a bit, break just above, only to break back down for newer lows. So generally speaking, in bad bear markets, that's consistently what happens. You saw it here in 2007, 2008. You saw it a little bit in 2015 to 2016, and then yet again in 2020. So if this is the case, I'm not necessarily saying I'm ultra bearish just yet, but I do think we're starting to get a lot of warning signals. It's kind of like when winter is coming, right? Ultimately, you know it's coming because you're starting to see during the fall, the leaves are turning different colors and they're starting to fall from the trees. We're starting to get a lot of those warning signals. Again, when we look at this double top, it's not looking too hot. We failed to break to a new high, only to break down pretty hard right here for a low that was lower than our previous low. And yes, the markets rallied really strongly on Wednesday, September 11th, but that was because we had a very cool inflation reading at 2.5%. And in this article from the Wall Street Journal, it says inflation extends cooling streak to hit 2.5% in August, and that is year over year core CPI. And so this is a very positive indicator that the Fed is finally catching up. However, a lot of negative incoming indicators and readings on the market are starting to make them worried. And so they are going to say, hey, we have to kind of step on the brakes now. And now we have to lower interest rates in response to a weakening economy and an employment market. As many of the central bankers have signaled, they are prepared to cut rates, and Wednesday's consumer price index reading won't change that outcome. But because inflation is cooling quite a bit, even though unemployment is up and jobs aren't looking too good and a bunch of other factors are starting to get them a bit worried, they're highly likely to lower interest rates by 25 basis points and likely not 50, because that would spook markets. It's predictable. But I don't think the rate cuts are going to stop there, and I actually think they're going to accelerate as we see a worsening economic environment. And this is one of the major indicators that we just talked about at the start of this video, which kind of has a lot of markets worried if they know what to look for. The Federal Reserve is proposing sweeping new bank regulations, and they are requiring that capital levels would increase by 9% for regional banks under the proposal. At first, they wanted a 19% increase, but they are lowering the standard to 9%. Now, what exactly am I talking about? Well, we're talking about fractional reserve banking. And this is exactly how these banks make money, out of thin air. Basically, they take your money and they are only required to keep so much of it on hand at any given moment by law. So that way they can, if you want to go and withdraw, they can give it to you, but they couldn't give it to everyone if everyone wanted it, because that would be considered a bank run, and then the bank would go technically bankrupt. Fractional reserve banking is a system in which only a fraction of bank deposits are required to be available for withdrawal. Banks only need to keep a specific amount of cash on hand and can create loans from the money you deposit. Fractional reserves work to expand the economy by freeing capital for lending, essentially printing money out of thin air. Today, most economies' financial systems use fractional reserve banking. Now, I actually had to do a bit of homework to know exactly how much bigger banks need on hand based on the requirements and under the law. The capital reserve requirements for banks in the US depend on their size and risk levels. For large banks, they need to keep about 4.5% in their reserves. That's an insanely low amount. Think about that. If I deposit $100, they only need to keep $4.5 in reserves at any given moment, and then they can go basically loan that out, do whatever they want, and then create more money out of thin air. On top of that, they must hold additional capital buffers, such as the stress capital buffer, which varies by bank, but is typically at least 2.5%. So imagine now we're at 7%. Smaller banks, anywhere between 100 billion to 250 billion, typically have lower requirements. And this is what keeps the financial system from totally collapsing under major economic stressors. In other words, this is very big news, because what this means is the Fed was going to require banks to have about 19% on hand for their reserves, but now they're lowering it to only 9% for the big banks. Why would they do that unless we're already seeing a lot of weakening in the economy and they're worried that so many banks would be stressed to the max, and that would cause a lot of failures and panic and ultimately harm the markets? For smaller banks, they're only going to boost the capital requirements by like 3 to 4% gradually or over a period of time. So yes, it seems that the banks and the Fed are a bit worried about the current economic state that we're in. But those aren't the only interesting economic indicators that we're looking at. We're also looking at the US 10-year bond yield, which is indicated by the chart that is on here with the colors. And then we have this purple line, which is the US 2-year bond yield. And when we get a bond yield curve, what that simply means is that the short-term bond is actually inclining and now above the longer-term bond in terms of the yield that you would get. And we actually had a yield curve inversion for a very long period of time. This is the longest inversion that we've had since the Great Depression back in 1929. So this is a very big deal. We're looking at 790 days where we, for the very first time, very recently, we just had a normalization of those yields. And here is another way to look at it. I just took the 10-year and divided it by the 2-year. And as you can see here, this green line is that 1% range. So anything below it would be an inverted yield, and anything above that 1% would be a normalization of the yield. We just crossed the Rubicon for the very first time in 790 days above that 1% for a normalization of the rates. Now, why does this matter? Well, I'll tell you why. Typically, when we start to move into this territory up here after a long-term yield curve, especially one as long as this, it's indicative of recession. From Investopedia, a yield curve inverts when long-term interest rates drop below short-term interest rates, indicating that investors are moving money away from short-term bonds and into long-term ones. This suggests that the market as a whole is becoming more pessimistic about the economic prospects for the near future. Such an inversion has served as a relatively reliable recession indicator in the modern era. Now we're going to look at a chart just to see when these recessions happened and how often they happened and whether or not we are on the start of one right now. So right here we have a great image from this account game of trades, again on that 2-year, 10-year US Treasury yield curve. And as you can see here, anything below the 1 range is considered an inverted yield. And whenever we start to cross above, okay, recessions are usually close on the tail. So right here, these gray lines indicate a recessionary environment back in 91, again in 2000 during the dot-com bubble, again in the housing bubble, and then finally in the pandemic. We had a yield curve inversion, right? Then we start to normalize, and then a recession follows shortly thereafter. Well, that just happened, and it is very much possible and potential that as the interest rates are lowered from the Fed, they're doing that in response to a very weak economic environment. Then it doesn't help that another major recessionary indicator is starting to flash, with gold reaching new all-time highs. Gold prices are near a record high above $2,500 an ounce, and Paulson noted that gold does often do well during times of rate cuts. That is because the Fed is often lowering rates in response to an economic slowdown, which we just talked about, or even a full-blown financial crisis. When that happens, gold does have a lure as a haven, and we would hope that crypto does and Bitcoin does, but right now they are still relatively young compared to gold and the amount of recessionary environments that it has experienced. And here we have a weekly chart of gold. As you can see here, we were really playing a lot with this 1900 to 2000 range for quite some time before finally breaking out and really rallying strong to the upside. And this is an indicator that not only central banks all over the world are picking up gold to de-dollarize, right, but that a lot of major investors and players are too, because they're worried about a recessionary environment. So with all of these negative or weak economic readings, what's actually going on? It seems that markets still have some fight left in them, considering that the current inflation margin reading was actually relatively low, and that's what allowed markets the confidence to rally so strong today with a very long wick to the downside. So if we break above these range highs on the S&P of like $5,650, then I would say we're likely going to continue to rally through September and into the rate cut. However, into the rate cut, I think it's really important. I believe that's the 17th or the 18th of September. You're going to want to watch closely, because if markets really start to sell off hard after that rate cut, then I believe we've locally topped. However, they can continue rallying after the rate cut, maybe into the second rate cut or into October. But by then it remains to be seen. My personal take and opinion is that we're probably going to rally a little bit more. And if we do break above here, we're probably not going to break too much higher. But again, I've been proven wrong by markets many a times, which is why I don't like to speak in total certainties, and also why I want to prepare you for anything that's going to come here in the near future. This is a strong indicator that there is strength in the market still, and so it is very much possible you break out to a new all-time high. However, if we do not, then that is a very strong signal that we are weak and that things are finally done rallying. So you're watching this video because you like XRP, or you're an XRP investor. What does all of that mean for you? Well, ultimately, the crypto markets are driven by the TradFi markets, and it's not necessarily that, it's always the same investors and so on and so forth. It's just that they're treated as risk-on asset classes, which means asset managers, the people with all the money, typically dump both crypto and stocks in a weak economic environment, or an environment where they're worried about recession. On the flip side, in environments where they want to take on risk, right, they would typically rally into asset classes like this. So that said, under the situation where the market starts to rally to the upside, it is very much possible that XRP also starts to rally, considering we are starting a new uptrend. Okay, from our local lows right here, we've consistently been supported, whether it's on a wick or an actual closing candle right at this trend line. If we break below the trend line because the S&P 500 and TradFi markets look weak, then it's very much possible we break down to at least 47 cents to maybe even 42 cents. And I do believe those are a great dip buying opportunity if we rally through the end of the year like we usually do in a bull market. However, this has been a very long, dreary summer lull, and now we're into September. Summer is over, but usually, and like last year, right, the rally really begins in October and maintains its strength through January. That said, my major buy zone would be anywhere between 45 cents down to 30 cents. I think those ranges are really good dip buying opportunities. However, if we do not break down and we start to rally back up to the 64-cent range and break above there, I do believe we're going to rally to new yearly highs, considering our most recent all-time high was about $1.96. I think that's very realistic and potential this year. If the markets remain really strong, we'll just pull up another chart with more history, then I do believe we could potentially hit that $3.31 range, considering this has been a 6.5 year triangle or pennant. So here I would have these trend lines from the top on down and then from the bottom on up. And as you can see here, this is a very long, some would argue bull flag. You could call it a pennant, whatever the case may be, but we are on the lower side. And so any wicks to the downside right here, I think again would be a good dip buying opportunity. And then we would want to see the price climb right back up to that 75-cent range. However, we might still have some time left in us. It could happen sometime in October, but it's likely going to happen sometime in November, December, if and only if we see strength in the general market environment and in Bitcoin. And most people would argue, especially in the XRP community, well, that's not true. That's not what XRP is designed for. But I'll tell you right now, XRP has underperformed Bitcoin the entire year. And that's not to bag on XRP. It's just the facts. It's reality. And so the more that we come into, I would say, union with reality, the more likely we're going to be better investors. We're still very bullish XRP, especially with a long, strong range like this where we're near the tail end of it into a potential breakout. But we also have to get with reality and realize that it can take some time, and that ultimately it's very correlated, positively correlated with general market health and Bitcoin. If Bitcoin is going down, typically XRP is going down. If Bitcoin is going up, then XRP now has room to breathe to the upside as well. So if you enjoyed the video and you're going to be a holder of XRP over the next coming months, or you plan to buy XRP on any given dip and then hold into the end of the year, because I do believe we're going to start to see some serious rallies. I'm more bullish than I am bearish right now. That said, I will be accumulating on any major dips between that 45-cent range, and if we were to wick for whatever reason down to the 30-cent range, I would buy that too in droves. Okay. However, if you are going to be in that camp, then you should head on over to bullrunners.com. You can find the link in the description below, and all you have to do is enter your email to land on this page. Once you're on this page, you can watch this 8-minute video where Nick explains how you can earn up to 1,000 to 2,000 XRP per day by putting your XRP to work in the #1 play to earn XRP game. And you do that to earn crypto. Okay, it takes about 10 minutes per day. You do it in 3 very simple steps. First, you get your XRP wallet. Then you get your game pieces. Finally, you play the game and earn the crypto. And the crypto is directly convertible for XRP. So it's a great way to reduce your volatility in the case that we see some downside. It's a great way to stack up and compound on your bags in the case that we get a massive blow off top or a rally into the end of the year, because we're nearing the end of that triangle. You have nothing to lose and everything to gain by simply checking it out. Go to bullrunners.com. I look forward to seeing you on the other side. If you enjoyed the video and you learned something, go ahead and like this video, subscribe, and I look forward to seeing you in the next video, my friend. Goodbye.